This is the 2025 FOREX TRADING EMPIRE Mentorship Program, Lecture 26. The topic for this lecture is Daily Trade Plan Review. In this lecture, I'll be doing a trade review on using the daily trade plan. We're going from the higher time frame down to the lower time frame, explaining how to utilize the concept of the power of three, how to wait for price to manipulate and look for your entry after the manipulation. And the focus of this entry model, so the entry model is going to be used in this example, is going to be the 8:30 to the 10 a.m. setup. We'll be looking for an entry within that time range, which is supposed to be after a high impact news. So doing this trade review, during the time I executed on this trade, it was after a high impact news on Thursday. So it was a CPI news after CPI on Thursday that I executed this daily trade, and I'll be applying the daily trade plan during the review. So let's move to the chart. So I'm on the daily time frame of USD CAD. So on the daily time frame, we're trying to identify the next draw on liquidity. Where's going to be the next draw on liquidity, and where has the high probability of price closing either as an up close candle or as a down close candle. So from this price action of where we can clearly see the price is trading lower, leading to this sell side liquidity. We can clearly see the price is leading to the sell side liquidity, going for this swing low. Because since price traded lower, look at the sell side liquidity. The next draw on liquidity, if price were to keep on trading lower, is to see price run up this sell side liquidity. And seeing that price the retracement back to a daily fair value gap, respected the daily fair value gap, led to a down close candle outside the daily fair value gap. Now, clearly, you can clearly identify this as a downtrend, anticipating lower candle, a down close candle to run out this sell side liquidity, previous day low, and go for this swing low, this sell side liquidity. Because price traded lower from the daily fair value gap, daily fair value gap, daily fair value gap. Seeing the price reacted from the first fair value gap is a high probability that price might continue trading lower, going out for the sell side liquidity because price did not retrace much into the price range. Price stayed at a premium at a discount daily fair value gap, stayed at a discount daily fair value gap, respected the discount daily fair value gap because price might be working from a 4-hour premium liquidity. So there are still many criteria leading price trading lower. If you look at this from a 4-hour perspective, this might be price going for a premium 4-hour liquidity. After the run on the premium 4-hour liquidity, shift in market structure leading to lower prices. So it's not all cases that I wait for price to trade above the mid range, above maybe if I were to sell, which means I'll be looking for price to trade to a premium liquidity, which would be this fair value gap or to the mid range of this fair value gap. It's not all cases. There are still some scenarios as long as price on the trend continuation, there are short retracement like this where you can only see two candle retracement to a fair value gap or sometimes a few candle to the lowest fair value gap at a discount level, leading to more discount price. So always pay attention to the reference points because this is a daily fair value gap. Seeing the price is reacting from the daily fair value gap is a clear indication to anticipate lower prices to go for the sell side liquidity and for the swing low because price is reacting and we're expecting this daily fair value gap. So going down to lower time frame, we want to identify the shifts in market structure after this candle close. After price close outside the daily fair value gap, we want to see the trend still aligned. You can use the 4-hour trend and you can still use the 1-hour trend. The point is that you want to see an opening price on Thursday. You want to see price trade above the opening price, trade to either a 4 hour reference point or a 1 hour reference point. Then you look for your entry after price respect or trade through that reference point. It might be a buy side liquidity or a 4 hour fair value gap or a 1 hour fair value gap. Point is that we want to see price from a simple power of three, opening price, manipulation, distribution, then a closing price. We are looking for a simple power of three on a lower time frame. Price trading, manipulating to a 4 hour reference point, 1 hour reference point. The point is that we are looking for lower prices and want to see price trade above the opening price, take out the liquidity before trading lower. So let's go to the 4 hour time frame. On the 4 hour time frame, here's the opening price of the candle. So price open, trade above the opening price. Remember, we're looking for price to manipulate above the opening price. Manipulated above the opening price, traded to a 4 hour fair value gap, and this 4 hour order block, a state in change of delivery, where price traded through this fair value gap, 4 hour fair value gap, try to trade higher, fail, state in change of delivery, led to lower prices, fair value gap, order block. Price retraced to the fair value gap and the order block. After price respected the 4 hour fair value gap, led to lower prices, took out this swing low, and took out the previous day low. Previous day low and Monday's low. So you can clearly see the power of three, which is very easy to point out in this example. Opening price, manipulation phase, and a distribution below the opening price to run out previous day's low. To go sell side liquidity, and our target is to see price run at the previous day low when we are using a daily trade plan. You can see how price respected the 4 hour fair value gap. After price trades to this 4 hour fair value gap, these are the times where you go to lower time frame to look for your entry. And looking at this time, this should be around the specific time. It was at the same time where there was a high impact news, the CPI news. CPI news led the price trading into the fair value gap. After 8:30, looked for my entry, anticipating lower prices. Price traded lower, run out the sell side liquidity. We'll be using the entry model, which I've talked about. We'll be using the 8:30 to the 10 a.m. entry model, and we turn on the session indicator, paying attention to the New York section because the 8:30 to the 10 a.m. section fall into the New York section. So the entry model will be at the New York section. So moving down to the 5 minute time frame. First, we'll go to the 1 minute time frame and I will explain why I didn't use a 1 minute fair value gap as an area where I've been looking for price to respect to anticipate lower prices. So let's go to the 1 minute time frame. On the 1 minute time frame, prior to the New York section, price traded through this swing level, gradually retracement, trade to the premium area of the swing level, retrace. Prior to the New York section, price was at this high, leading to this high. So these are buy side liquidity, these are premium liquidity. I'm looking for price to trade through. And after running the premium liquidity, where is price actually trading to from the higher time frame? 4 hour fair value gap. So you can see it's still aligned with the higher time frame, with the 4 hour time frame. I'm only using the 4 hour fair value gap to make it more easier for you guys to understand when it comes to identifying the next draw on liquidity. Price took out the 4 hour fair value gap, shift in market structure, retracement to a 1 hour fair value gap, respected it, let's lower prices for price to run out the sell side liquidity. But this entry is at the 10 a.m. to the 11 a.m. setup. This is the last trading hour setup, which I'll be talking about once we get deep into the 2025 lecture. But first, let's talk about the basic and easy bread and butter setup, which is this setup I'm pointing out using the 8:30 to the 10 a.m. setup. Taking a sell, try to take advantage of this sell, going below the opening price, running out this sell side liquidity. We are looking for this easy bread and butter setup, the specific time. Before your entry time frame, look at what price have done. Know where is price we're expecting and where is going to be your next draw on liquidity. Prior to 8:30, 7 a.m., price traded higher, took out the 1 hour buy side liquidity, 1 hour buy side liquidity into a 4 hour fair value gap and a 4 hour order block. Did a shift in market structure. You are anticipating lower prices from the daily time frame, which means seeing a shift in market structure, be anticipating lower prices for price to run out the swing low from the 4 hour, which is going to be the next draw on liquidity. So you can see how everything align itself when you stick to your higher time frame bias, wait for the alignment to align with your higher time frame bias. So let's move to the 5 minute time frame. On the 5 minutes, after price trade to the 4 hour fair value gap, you can see the shift in market structure, retracement to a fair value gap, like this bright, retracement to a 5 minute fair value gap, respected the 5 minute fair value gap, led to lower prices. Now, after this shift in market structure, seeing this impulsive move where price is reacting from the 4 hour fair value gap, respecting the 4 hour fair value gap, leading to a 5 minute shift in market structure, you should have been your first entry at 8:15. But since there's a high impact news at 8:30, you wait for you look for your entry after 8:30. I can say ideally 5 minutes after the high impact news. Those are the best time I do look for my entry. Once price open at 8:30, I wait for the candle to close. After the candle close, then I see if price is inside the fair value gap, I just execute on that entry, or I wait for price to form another entry to execute from. Which in this example, I didn't take advantage of this fair value gap. Price traded lower because I'm waiting for the CPI news. CPI news at 8:30 came out. I waited 5 minutes after the high impact news to see if there's going to be any impulsive price action because there's going to be high volatility when there's a high impact news in most cases. But in this example, in this review, there was no high impulsive move. Price only did a retracement back to this 5 minutes order block. Then I took my entry after the candle close at this order block. My target would be this sell side liquidity, which is the next draw on liquidity if there's going to be a lower prices. If there's going to be a lower prices, the next draw on liquidity will be for price to trade below the opening price and go for the sell side liquidity. So you can see the setup, easy bread and butter setup, sell, price traded lower, took out this swing low. Here's another block, retracement to the other block, respected the other block and the inversion fair value gap, lower prices, retracement, other block, respected the other block, led to our first target before the 11 a.m. to the 12 a.m. last trading hour. And here's the entry to our last target. So our main daily target, which is the swing low. But in this example, in this trade review, I'm talking about this specific entry after 8:30, the 8:30 to the 10 a.m. setup. Retracement, order block, entry drive, anticipating lower prices to run the sell side liquidity going below the opening price. And here's a target. Because you're looking for price to respect this 4 hour fair value gap, and if price were to respect this for fair value gap, you know the price is going to go for this swing low. This should be your first target, and you are looking to take your profit from your first target. Unless you're looking for an expansion lower, then you can throw stop, which I wouldn't advise at an early stage. As long as you can take an average of a 1 to 2, 1 to 3, you close your trade. As soon as price takes out the first sell side liquidity. But if you were to enter from a swing low and there's still not enough price range for you to catch a 1 to for you to ride a 1 to 2 or a 1 to 3, you can just use your fib, which has been explained on previous lecture. Place your fib, measure the retracement, then anticipate price to create a one standard deviation. Then you look for price to trade to your one standard deviation, take your target. For this example, price was still inside the price range, and our target price is still far away from our target, which this was around a 3.5 hour trade. I think it was a 3.6 or 3.5. So I entered on the open of this candle. So it was a 4.5 hour trade. And you can see how price traded lower, took out the sell side liquidity before the retracement of the 10 a.m. to the 11 a.m. Retracement back to a 1 hour fair value gap that led to these lower prices to go for the sell side liquidity. And that is the model on its own, which I'll go into that model more, but I'm teaching you guys the easy bread and butter setup. There's still some complication to this 10 a.m. to the 11 a.m. retracement back to the range before the complete expansion of the last trading hour of the London section. But we'll get into those types of entry model later on the 2025, kind of close to the end of the 2025. I'm just expecting you guys to find profitability or to find a repeatable model from the New York Q zone and the London Q zone. These are the most specific time where you find high volatility that will give you enough momentum to your target. So this is an easy setup, the 8:30 a.m. to the 10 a.m. trade entry. And this can be your only model which you are sticking to, and you can trade one or just two currency. If you're going to be using the weekly bias, you can use three currency, but if you're using the daily bias, stick to one currency. I'll be talking about this entry in this lecture, in the 2025 lecture, because I'm giving you guys a specific time to look for your entry so that when you are trading, for those that don't have much time to look at the chart because of their daily activity, you can have a specific time, a 1 hour plus, at most 2 hour time range to go into the chart, look for your entry if you have a bias. Because in this example, remember, this is a build up. This entry wasn't just an entry I just executed on, anticipated lower prices for price to take out the sell side liquidity. It was a build up from the daily time frame. Before the opening price, I told you guys I was anticipating lower prices. And I told you guys I'm looking for price to trade above the opening price, trade to a 4 hour liquidity pool or a 1 hour liquidity pool. It should be a buy side liquidity or a fair value gap, a premium fair value gap. Price traded to a 4 hour premium fair value gap led to lower prices, took out the sell side liquidity. You can easily use this for back testing depending on the model you choose. Spend your time, do the back testing. You're not trying to predict, you're trying to educate yourself with the back testing, not trying to look for accuracy or trying to see if you can map out the amount of percentage you can make a month. So you're just trying to understand the model more. You haven't gotten to that stage. I can say for any trader going through this lecture, I'm pretty sure you haven't gotten to that stage. So it's better for you to just stick to a specific model to make it more easier. Or you can If you have more time, you can stick to a whole daily buys model, like using the whole daily trade plan or using the whole weekly trade plan and looking through the section. You can pick one entry model to make it more simpler for you to repeat because you are not trying to make it more complicated and you're trying to grow the patience to wait for the right time to execute your trade. Because if you notice, during the 3 a.m. to the 4 a.m. setup, you weren't supposed to be looking for any entry. Why? Because price haven't run out the 1 hour buy side liquidity. Price traded close to the 1 hour buy side liquidity, failed to run the liquidity, did a retracement. 3 a.m. price created a fair value gap, respected the fair value gap, lower prices. This is just a retracement before the main move for price to trade to run out the buy side liquidity. Now, there are other ways you can trade this, but you need more experience to trade a move like this to anticipate price to run the swing low before anticipating a retracement back to the 4 hour fair value gap. But I'm showing you guys the easy setup to that you can easily identify. I already give you guys the set of rules you'll be following to take these trades. Wasn't looking for an entry from the 3 a.m. to the 4 a.m. setup. Wasn't looking for any entry from the 7 a.m. to the 8:30 setup. It was after the high impact news that I looked for my entry at this other block, anticipating lower prices for price to run out the Wednesday low. Like I said, this is Wednesday low, previous day low at the opening price. Here's the opening price, previous day low. Price took at the previous day low. After price retraced to this other block, led to lower prices after CPI. You can do your back testing, choose one model, and make sure you stick to the model to grow more experience before adding up model but executing on the same trade plan. Because if you remember, the bias is still the same. The same way I look for my bias is still the same. It's either I'm using the daily bias or I'm using the weekly bias. Where on the daily bias, I'm trying to anticipate if the next day candle is going to be an up close or a down close candle. The same thing goes to the weekly bias. I'm trying to anticipate if the next week is going to be an up close or a down close week. Which in this example, I was anticipating a down close day that led to this lower prices for price to run at the sell side liquidity. And you can apply this logic to any currency pair. You can see this example. I basically trade at this time. I do trade only three major pairs on the forex markets. I trade Euro USD, GBP USD, and USD CAD. Those are the ones I do take entry on. I do look at other currency pair just for educational purpose. Maybe when there's no bias within my trade currency, I just move to other pair where I can clearly see a bias and I just monitor it, not executing on it. Sometimes I demo trade it, but I have a specific currency I do trade. Now, I'm not advising you guys to pick out three currency at your early stage. I've looked at the market for a very long time and I've been trading for a very long time at this point. So I can say my experience is well enough for me to trade multiple currency. I can't even go above three. I can trade above three, but in order for me to have that high focus and to be well aware of my currency pair to take trades on it, I had to bring down my currency pair that I do trade. At first, I was trading one currency pair, but I later added GBP USD and USD CAD just to increase the frequency of my trades. You can do the same only when you have the right experience, but you start with one currency. It doesn't matter whatever bias you choose, either the weekly or the daily. Start with one currency. You can practice on other currency, but you're trying to find consistency in whatever you're doing and trying to fix yourself in one specific model, one specific approach, so that you can easily copy that, repeat it multiple times on different currency. And those are the times where you finally decide on the currency you trade on. Is either you stick to one currency or you add maybe, I can only say don't go above five. If you're trading the weekly buys, just stick to three currency. But if you're trading the daily buys, just stick to one currency because there's a whole lot of drama moving within those currency pair when it comes to lower time frame entries. So just stick to one currency if you're using the daily buys and stick to three currency if you're using the weekly buys. And try to pick currency which have few correlation. There's still some diversification among those currency before picking the currency, which I'll do a specific lecture about how to pick multiple currency if you choose to pick multiple currency. Now, when you choose multiple currency, you'll be distracted, or let me just say you need high focus to trade it, not distraction. Just use the word high focus. You need high focus to trade those currency pair. So you need to be really dialed in to trade multiple currency. So make sure you do your back testing. Watch this video a few times to understand this trade review. And that is all for this lecture. See you guys in the next lecture.